how to save your home, your house, from high interest rates right now if you're worried. Now, I'm going to be giving you all the tips and the tricks and everything that I've kind of figured out on just talking to other people on how to save your house if you're feeling the higher mortgage payments right now because of the interest rate hikes from the Bank of Canada. Or honestly, if you are just scared of the upcoming mortgage renewals, which again, everyone's situation is different, but if you have one coming up, I want to give you the tactics for that. Because I want you to know all the tactics and strategies so you can keep the roof over your head right now and for you and your family before you kind of contemplate selling, because nobody wants to get into that position where you're forced out of your house financially, right? So make sure you stay tuned to find out. Now, if you're watching this video and you are applying all the tactics and the strategies that I'm going to be providing for you in this video to save your house, and it still is not going to work and you think you're having trouble, you can book a call with me using a link that's on the screen to kind of discuss options and everything else under the sun before we really have to talk about if you have to get rid of your home, right? And you can give me a call using the link that's right here or book a call. It's www.chatwithzen to discuss your options. Simply click on the date and the time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you. And if you found any of these videos helpful in your real estate journey, whether you're buying, selling, or investing, or even trying to rent it out to tenants out right now, or in your case right now, if you're trying to save your home because you're feeling the high interest rates right now, then help me smash the like button so that spreads a lot of this knowledge out there to help other people who are in your situation, or again, just some real estate curiosity, right? Now, I'm making this video as a follow-up to last week's video where I talked about whether investors should be offloading the properties to kind of survive, right? And I want to make this video so that it helps the people who are not investors to survive, because not everyone has a second home where they can let go of, get some of the money back so that you can keep the home you're living in on the off chance the interest rates are kind of kick you out of the home. So this video is for homeowners without investment properties and how you can actually save your home, meaning that the home that you own is your primary residence, your family's in there, you live in there, and we'll do whatever we can to try to survive and save the house because of the high interest rates. Now, I'm going to break this down into kind of like two segments, right? So you're going to have those who are feeling the interest rates right now. So I would say these are kind of homeowners that have a mortgage at Scotia. They would have it at National Bank, because those are the mortgages where the payments are going up. And then we're going to have a second part, which is people are concerned about the impending mortgage renewal they have, or they have like a static variable, meaning the variable hasn't moved, with like say CIBC, BMO, RBC, and TD, right? Where you're essentially negative amortizing. And if you want to jump to that spot right now, I'll put the timestamp like right here. Now, before I get started, right, I just kind of want to convey a piece of wisdom once from my mentor who kind of like was teaching me for a lot of things, right? And it's this: do the things you can control, not worry about the things you cannot control. And in the case of interest rates, right, despite how much you follow it, read about it, inflation, jobs, jolts, et cetera, and study it, it is ultimately out of your control. It's out of my control. So hope isn't a strategy. That's praying for something you cannot control to change the direction of your life, right? And it sounds like tough love, but for you to survive, you need to take tactical action to save the house and not just hope, right? Okay, so segment one, adjustable mortgages. So right now, about every 25 basis points or 0.25 in the rate hike means that for every $100,000 of mortgage you owe, your payment goes up, give or take about like $15, okay? So while it is good in this case, and people spin it this way, that you're paying down your mortgage and you are not negative amortizing like all the other banks, right? So Scotia and National are not negative amortizing. The change in the cash flow could be a killer, right? So I would say the first thing you want to do is call your bank and ask for a skip payment to give yourself a little breathing room. Scotia has allowed it, especially in the past if you have made prepayments to accelerate your amortization, which is the entire duration of how quickly you pay off your mortgage. Now, from my knowledge, National does not have this option, unfortunately. So the skip payment that's going to give you some breathing room doesn't go away. The amount you owe is actually tacked on to your mortgage that, again, you ultimately still have to pay, and it does accrue interest. But again, it's to give you some breathing room, right? Because right now, for you to survive, it's a cash flow game where you're trying to buy more time to survive until the rates come down, not just hope that they come down, right? I mean, they will, right? But like, it's just how long you can survive for. Now, the next is if you have equity in your home and you can qualify, you can try refinancing in this environment to stretch out your payments. So if you have some equity and you were say like 20 something years, you can go back to 30, right? Just keep in mind, currently right now, you are requalifying at 8%, which is difficult for most. And frankly, it's difficult for anyone who owns their own home to requalify right now. And if that doesn't work, then you can call your bank and declare some financial hardship and see if they can work with you to increase your amortization past the standard 30-year limit, right? This way, it stretches out your payment. Now, if this is a new home that you're living in right now and going from a 30-year amortization to a 40-year, I'll put a screen up over here. This is roughly how much you can save on roughly, call it $1 million mortgage, which I would say a lot of people have, okay? Now, if you increase your amortization schedule, meaning you extend how long it takes for you to pay it back, the numbers, like on a monthly basis, are going to look better. Maybe they're more tolerable. But do keep in mind, the longer you stretch out your amortization at these current rates, the more interest that you pay to the bank over the duration of your mortgage. So again, we're trying to create some breathing room and some cash flow, but this is not a long-term solution unless you can have a look over here. You want to pay 1.5 times your loan amount just in interest alone. So it's not a long-term solution. Again, this is to buy time so that when rates come down, you could pay it off faster without having to sell your home. Now we have to talk about the hard stuff, your income and your lifestyle. This isn't what most people want to hear, but for you to survive, there's two things you could do: increase your income or decrease your expenses. And in our current economy, thank goodness for the internet, there are lots of side gigs you can do, right? So you have a lot of people opting for food deliveries, driving Uber, renting out parts of your house. Yes, I know it's controversial because, like students, et cetera, et cetera. You could also do homestays for international students. That's actually very popular. Or you can just kind of like opt into Fiverr and kind of sell your skills, right? Those are ways to increase your income so that you can pay for higher mortgage expenses. The other one is reduce your lifestyle, which I suspect most people will do first, right? But my thought process for reducing your lifestyle, again, if allowable with commute, family, kids if you have any, right, is to rent the current home you live and you own and rent somewhere else where it's cheaper and actually maybe even further or smaller to reduce your living expenses, meaning that the home that you have right now, when you rent it out, is going to be more rent than what you're renting somewhere else. Now, it may be a big ego hit for a lot of people, but that's what it's going to take to save your home. Now, my final thought for you in this scenario is this. If you do not do any of the things I just mentioned earlier, and you're waiting for the mortgage rates to kind of fall below 2% again, I think it's a fruitless effort. Again, hope is not a strategy. And again, sorry for like the tough love, right? But if inflation arguably stays higher because of deglobalization and we're kind of like onshoring all the other stuff, we're probably not going to see mortgage rates at 2% again. And if you're hoping for that, that means that you're never going to be able to afford your home and you're going to keep extending and pretending. Now, next, this is the renewals and the mortgage amortizations that are going negative, right? And I kind of put this together because they're kind of the same thing. I know they're technically not, but they're kind of the same thing, right? There's technically no real action for you to take right now, despite a lot of the letters, such as this one, that are being sent out by your banks who are notorious for negative amortization, such as CIBC, BMO, and TD, right? Now, this letter is going out because of the banking regulator, OSFI, is telling the banks to do something about the negative amortization because it's a bad look for them, right? And this letter that the banks are putting out there is kind of like a theater, and it's putting shock in the market. But you do not have to do anything. You don't. So negative amortization, like I was saying, is like renewals because where there's likely a payment shock when your current mortgage term ends, like when your contract ends, right? So the underlying principle in this kind of like situation to survive is to build up a cash reserve for the proverbial renewal shock, right? because you know it's going to go up, right? Just looking at all the data. And like the adjustable rate mortgage, if you need the cash flow or you need to kind of like build up that cash reserve, emergency fund or whatever, skip a mortgage, get some cash flow from it. Just call your bank, fairly easy, right? I'd say most of the banks that are negative amortizing will let you do it with the exception of CIBC. Now, if you have the cash right now and you're thinking of making a lump sum payment because you got the letter from the colorful banks to reduce your monthly payment in the future, or in this case, like increase it right now so you can reduce in the future, here's my 2 cents, right? If we are heading into a recession and all things are pointing to it, even if it's mild, right? And your job or your income, right, your source of income is at risk, I personally think it's better off hoarding that cash and just keeping it as emergency funds in case you actually default on your mortgage because you have no income coming in this potential recession. And that is how you're forced to sell. That's kind of why I don't think Bank of Canada is concerned right now as much, but if there's job employment, then we have a problem. Now, if you're concerned about the interest that's accruing because you can pay it back down right now, just put in the temporary GIC, even if it's locked in for 1 year. That is a lot more liquid than if you put the money into a mortgage. And obviously this depends on how many years you have left on your term, but it's very hard to get that money back out, especially when the qualifying rate is so high on the refinance, right? Plus, if we do hit a recession, credit and liquidity will freeze. Even though it's kind of frozen now, it'll freeze some more. And you'll have a much harder time getting that money out of the home. So that's why I've personally just opted to keep the money in a GIC for emergency funds. Now, if you're coming up for renewal sooner than later, know that very likely you do not have to qualify, again, with the stress test, at your current bank. You can still shop it around and try to get the best rate regardless. But if you want to move to a different bank, say if you're going from like a B to an A or like an Alt A to like an A, you're going to have to requalify. And if you have some equity in your home and you're contemplating refinancing to reduce your payments, kind of like in the first example where you stretch it out, you may want to wait until interest rates are lower. Again, it really depends on the remaining term. And if you have a very low locked in rate right now, don't do a blend and extend. That's a ripoff. Just wait. Now, we've honestly likely peaked in this hiking cycle, right? But if you have to renew in the next 6 months and you're going to hit a payment shock, do the same thing I said earlier in the first example, right? Increase your income, reduce your expenses, and if you really, really need to, apply for financial hardship. It's in a lot of the budgets and like a lot of the banks to kind of help a lot of the homeowners out. It's a bailout, unfortunately, for first-time homebuyers. And if none of those things work, then you can start thinking about selling your home, downsizing to something that's a little bit more tolerable for your income level before you were actually forced to do that by the bank. And again, the bank doesn't really want to do it. It's just if you're not paying, they're going to have to get their money back. Because everyone's situation is very different. And from the calls I've gotten, it's never the same, but it always stems from a money problem, right? And the rates being higher. So if none of these strategies, tactics are able to help you save your home, then you can give me a call to kind of discuss how we can actually save your home and you be in control of selling it before kind of the bank takes possession of it, right? Because honestly, nobody wants to sell the home because they cannot afford it, right? And no one wants to sell their home outside of their own control. It's a really crappy situation. I've seen it from some people and some clients, and it sucks. So I hope this gives you some useful tips and tricks on how to save your home in this high interest rate environment. It is a rough time right now with how high interest rates are. A lot of people are feeling it. Everybody is feeling it, like from what I've talked to. And I know it's tough, but apply some of these strategies and try to survive. There is light at the end of the tunnel, right? Interest rates are going to come down. I don't think they're going to stay this high. And if you truly are in a pickle and none of these strategies work, you can book a call to discuss what other options you have with me, including selling your home using a link that's right here. It's www.chatwithzen.com. This way we can come up with a plan to kind of get you back on the feet after you sell it and try to get back into the market and home ownership. And this way you're not just kind of forced to move out of your accord, right? Anyways, I hope this was helpful for you and gives you some ideas and helps you save your home. Until next time, your move, your future. See ya! Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?